Respected presenters, dear participants, ladies and gentlemen. The subject of my presentation is key drivers of gold price fluctuations. Over the past several decades, gold prices have been shaped by a wide range of factors, experiencing notable fluctuations and dramatic shifts throughout its history. Between 17th and late 19th centuries, gold served as the backing for most currencies. Paper money and coins functioned as representations of physical gold, while international trade largely depended on gold for settling transactions. From 1833 to 1933, gold prices remained steady at approximately $20 per ounce. In 1934, President Roosevelt set the gold price at $35 per ounce, where it remained stable until 1967. That year, the gold price was deregulated, allowing it to be traded freely on the market. From 1967 onward, gold prices experienced significant increases accompanied by rapid fluctuations. Gold prices in the 1970s experienced a dramatic surge, driven by a combination of economic and geopolitical factors. The collapse of the London Gold Pool Agreement in 1968, followed by the end of the Bretton Woods system in 1971, which abolished the fixed exchange rate between gold and the US dollar and allowed the dollar to float freely, disrupted global gold market. This period also coincided with the stagflation crisis caused by the petroleum crisis of 1970s, which affected the United States and other industrialized countries. It was marked by high inflation, stagnant economic growth, and rising unemployment. These events created widespread economic uncertainty, significantly boosting demand for gold as a safe haven asset. As a result, gold prices soared to unprecedented heights, peaking at approximately $665 per ounce in January 1980. In 1999, gold prices hit a local low of approximately $253 per ounce. This decline was driven by robust performance of the US economy and strengthening of the US dollar, which diminished gold's attractiveness as an alternative investment. Additionally, an oversupply in the market contributed to the drop, as numerous central banks sold off their gold reserves to generate funds and diversify their portfolios. Between 2000 and 2006, gold prices experienced a steady upward trend, making the beginning of a long-term bull market after years of stagnation during the 1990s. Gold prices nearly doubled between 2000 and 2006, climbing from around $270 to over $600 per ounce. This growth was underpinned by a combination of factors, including a weakening US dollar, rising inflation fears, increased investment demand, and geopolitical instability. The global financial crisis that began in late 2008 caused significant turmoil in global capital markets. with rising risks across securities and futures. However, gold emerged as a safe haven asset during this period, experiencing a notable price increase. Gold rose from $672 per ounce in August 2007 to $933 per ounce in March 2008. Following the financial crisis in 2008, a flight to safety further boosted demand for gold, driving its price from around $730 per ounce in October 2008 to $1,300 by October 2010. In the early 2010s, gold prices increased, reaching an all-time high of approximately $1,900 per ounce in September 2011. This surge was fueled by the lingering effects of the global financial crisis, which drove investors toward gold as a secure asset amidst economic uncertainty and fears of inflation. After 2012, gold prices initially surged to $1,700 per ounce, driven by the loose monetary policies adopted by many developed countries to stimulate their economies. However, this upward trend reversed in 2013 as the Federal Reserve's tapering of quantitative easing signaled a gradual normalization of monetary policy and a strengthening US dollar. Gold prices declined sharply, dropping 29% from $1,695 in January 2013 to $1,200 by December 2014. During this period, gold faced a prolonged decline and stabilization, influenced by a recovering global economy, rising interest rates, and reduced investment appeal. Prices bottomed out at around $1,050 per ounce in December 2015. Following this low, gold began a recovery, rising to $1,350 per ounce by July 2016. From 2016 onward, gold prices began a steady recovery, regaining much of their lost value by 2019, with averages ranging between $1,300 and $1,500 per ounce. The onset of the COVID-19 pandemic in early 2020 significantly accelerated this upward trend as global market turmoil and unprecedented economic disruptions drove investors toward gold as a safe haven asset. In 2020, investor concerns surrounding the pandemic propelled gold prices to record levels, with a 27% increase from $1,575 per ounce in January to over $2,000 by the summer. In August, gold reached an all-time high of over $2,070 per ounce, fueled by the economic impact of the pandemic, global stimulus measures, and historically low interest rates. While prices declined slightly following the announcement of a coronavirus vaccine in November, they remained elevated, hovering just below $1,900 per ounce. Gold prices continued to stabilize through 2021 and 2022, typically fluctuating between $1,700 and $1,900 per ounce, as uncertainties related to the pandemic and economic recovery persisted. In late 2023, gold prices experienced a strong rally, breaking out from their post-pandemic trading range of $1,700 to $1,900. Prices initially climbed to around $2,135 before stabilizing just above $2,000. However, in April 2024, gold surged to new all-time highs of over $2,265 per ounce, driven by increased Chinese demand and persistent inflation concerns. This upward momentum continued, culminating in September 2024 when gold reached a record high of just over $2,500 per ounce. The price of gold is fundamentally determined by the interplay of demand and supply dynamics in the market. The balance between these demand and supply factors determines the price of gold in the global market. On the supply side, gold availability is influenced by mining output and recycling. Mining production is a critical component, but it is often constrained by rising costs, resource depletion, and environmental regulations. Mining accounted for approximately 75% of the total gold supply in 2024. Recycling of existing gold, such as from jewelry and electronic waste, provides an additional source of supply. In 2024, recycled gold contributed significantly to the global supply, accounting for approximately 25% of the total gold supply. It is consistent availability and environmentally friendly attributes make recycling a key component of the gold supply chain, helping to balance the market during periods of fluctuating mine production or heightened demand. Direct utilization and asset utilization represented the two primary structural components of gold demand. Direct utilization refers to gold's use in various applications, including jewelry, metal minting, electronics, and dentistry. Within this category, jewelry fabrication and technological usage are the two main contributors. In 2024, jewelry accounted for the largest share of global gold demand, comprising 48.7%, while technological applications represented 6.7% of total demand. Asset utilization represents another key structural component of gold demand. Renowned for its value as an investment asset, gold attracts governments, fund managers, and individual investors alike. The two primary elements of gold's asset utilization are investment purposes and central bank reserves. In 2024, investments accounted for 25.9% of global gold demand, while central bank reserves constituted 22.9%. The investment component of gold demand includes purchases made by individuals and institutions for the purpose of wealth preservation, portfolio diversification, or speculation. Inflation, interest rates, and the value of the US dollar, economic uncertainties, financial instabilities, currency devaluation, monetary policy, debt levels, and geopolitical risks all help drive the demand for gold as an investment asset. Real and expected inflation rates play a significant role in shaping gold prices, as rising inflation often drives demand for gold, pushing its price higher. Generally, there is a strong negative correlation between interest rates and gold prices. When interest rates rise, the opportunity cost of holding non-yielding assets like gold increases, as investors can earn higher returns from interest-bearing financial instruments such as bonds and savings accounts. This leads to a decline in demand for gold, often causing its price to drop. Historically, there has been a clear negative correlation between the US dollar index and gold prices. When the dollar index rises, indicating a stronger dollar, the price of gold typically falls. Currency values, particularly those of fiat currencies, play a crucial role in shaping gold's market dynamics. As fiat currencies like the US dollar tend to lose value over time due to inflation and other economic pressures, investors often turn to gold as a hedge against declining currency values. This perceived safety, combined with gold's long-standing reputation as a reliable store of wealth, ensures its continued appeal in times of monetary uncertainty. When markets become unstable or uncertain, investors tend to turn to gold due to its enduring value and liquidity, which makes it easily marketable even in volatile financial conditions. Gold's role as a safe haven asset becomes particularly prominent during periods of heightened geopolitical tensions. The escalation of geopolitical risks, such as the China-US trade war, Russian-Ukraine war, Israel-Palestinian clash in recent times, have prompted investors to seek refuge in gold, pushing its price higher. When global debt levels increase, it often signals economic uncertainty, potential financial instability, and risk of currency devaluation, all of which tend to drive up the demand for gold. Rising global debt levels amplify economic risks, lower confidence in traditional financial instruments, and often lead to inflationary pressures. These dynamics collectively enhance the appeal of gold as a hedge, leading to higher demand and consequently rising gold prices. Thank you very much for your kind listening.